Chapter 6, Understanding Key Cost Relationships. If you have only one product and sell to only one or two large customers, you don't need much of a cost system to learn where you are making and losing money. But companies typically have hundreds of different products and hundreds or thousands of customers. In this situation, traditional cost systems will not accurately trace a company's expense base to each product and customer. Robert Kaplan. Too many people think only of their own profit, but business opportunity seldom knocks on the door of self-centered people. No customer ever goes to a store merely to please the storekeeper. Kazuo Inamori. Firms earn revenue by selling products or services to customers in return for money. A firm's relationship with its customers is one of exchanging value. A firm is exchanging value with its customers every day. To be sustainable, this value exchange must benefit both the firm and its customers. Customers must receive something of higher value to them than the price of the firm's products or services. If they do not, they will soon stop buying it. Also, the price of the firm's products or services must be of a higher value to the firm than the cost of providing those products or services to its customers. Otherwise, a firm will quickly go out of business. In the exchange of value between a firm and its customers, one thing is clear and precise. This is the price of the products or services provided by the firm to its customers. There is a clear transfer of monetary value from its customers to the firm. The value to customers of the products or services is much less precise and depends on a customer's subjective assessments. Brands, fashion, and emotional reactions can all play a part in customers' perceptions of value. Also, a firm's assessment of its costs in providing products or services to its customers is not totally straightforward. It can be challenging for managers to understand and gain insights into a firm's costs, which are an important aspect to any firm. The question we will look at in this chapter is the extent to which accounting can help or hinder managers to gain a better understanding of what is happening to costs in their firm. We will look at how firms determine what their costs are and how these can be attached to different aspects of a firm's operations, such as its products or services. We will also look at the importance for managers to understand how costs behave in a firm, particularly in relation to changes in a firm's level of activity. We will see in this chapter the crucial importance for managers to understand deeply the key cost relationships in their firm and the extent to which accounting may be able to help or perhaps hinder them to do this. 6.1 Cost Objects. I've met them down in the cost and accounting department, clean-shaven and in white collars. They can't see a damn thing ridiculous about themselves, only about you. Jean Shepherd. Costs are being incurred everywhere in a firm. Costs involve money, resources and value leaving a firm. This is good if the value leaving a firm is being exchanged for something of greater value coming back to a firm. After all, incurring costs is a key part of doing business. How can accounting assist managers understand and gain insights into the value exchange with other parties that are involved when a firm incurs costs? One way accounting does this is to attach a firm's costs to various cost objects, like attaching fridge magnets to various fridge doors. Cost objects are simply different aspects of a firm about which managers want to have some understanding of their costs. It is also a bit like tidying up your bedroom by putting various stray and loose things lying around your room into those places where they belong. This can make your bedroom feel a lot tidier. However, if this process of attaching costs to cost objects is to help managers better know what is going on in their firm, it needs to do more than just make it feel like the firm is tidier with all the costs of a firm put away somewhere. They need to be put where they belong, to be connected to and linked to those aspects of the firm incurring the costs. The assignment of costs to cost objects requires more than a detached, superficial putting away of costs into different boxes. We will see it requires a lot more than that. A friend of mine, when I was a student at university, had a strong, messy streak. However, his room at one of the halls of residence at university was always so tidy. So tidy. There seemed to be a serious disconnect between what I knew about my friend and his room. One day I opened one of his cupboards and an enormous amount of stuff fell out of it onto the floor. I instantly resolved this disconnect. My friend was as messy as ever. He simply shoved everything into drawers and cupboards and kept the mess out of sight. Allocation of costs to cost objects can easily be like this. It can be a superficial, relatively unthinking throwing about of costs onto various cost objects, sometimes appropriately, sometimes not. If costs are linked to cost objects inappropriately, then the management accounts of a firm will certainly not help managers better understand their firm. Indeed, quite the reverse. It will make it harder for managers to see what is really going on. It will confuse rather than enlighten. However, to the extent costs are allocated to cost objects in a way that reflects what is going on in a firm, this can result in a firm's management accounts being able to support managers to better understand a key part of their firm's activities, how their firm incurs costs. Making sense of costs. Costs are related or connected to all aspects of a firm's activities. They are everywhere, under every rock in a firm. Understanding the relationships of a firm's costs to various aspects of a firm's activities is critical for managers. It is not optional, it is critical. This is because costs can all too easily get out of control in a firm. After all, firms are full of people spending other people's money. Also, a key role of managers is to set the way forward, to plan, to set objectives, and to motivate and inspire people in a firm to do things now that can affect aspects of the business in the future. Having a strong understanding of the costs of providing products and services to customers in the past and present will help managers plan and think about what these costs might be in the future. This is a vital part of planning and setting the way ahead. Attaching costs to cost objects. A key concept in accounting used to help managers engage with what is happening with costs in a firm are cost objects. Cost objects can be any aspect of a firm about which managers want to understand its costs. That's right, any aspect. It may be a product or service, such as the cost of a new retirement village unit at Nellie Melba Retirement Village in Melbourne. It might be a particular business activity or process of a firm, such as the marketing process involved in selling occupation rights to new retirement village units. It might be a customer or group of customers, such as individuals living in a rest home, including the cost of providing them a bed and related services in one of Ryman Healthcare's nursing homes. Ryman Healthcare, like any other business, has costs floating around everywhere. Indeed, in the year ended 31 March 2021, it reported total costs of about $462 million. That is a lot of costs. It is more than $1.25 million every single day of the year, including weekends and Christmas. These costs can be attached to various cost objects to help managers make sense of what is happening to costs in their firm. A firm will calculate its overall profitability each year by adding up all its costs and revenues. It is useful to have a reasonable measure of the level of profits of a firm each year. However, managers need to know a lot more about a firm's profitability than that. They need to have a clear understanding about which aspects of a business are contributing to the firm's profitability and which are not. Firms will usually have many different aspects to them. They are likely to sell and perhaps manufacture many different products and services. Firms typically have a range of different types of activities they are performing, often dividing their business activities into several divisions or departments or sections. A firm will typically sell its products and services to a wide range of customers, some of whom will be more important to the business than others. To gain an understanding of how much each aspect of a business is contributing to the overall profitability of a firm, we first need to be able to allocate or connect our firm's costs to the various parts of its business. Firms usually collect information about various costs in a business and then connect or link these costs to different cost objects, like attaching fridge magnets to different fridge doors in a firm. Imagine a house with a lot of fridges. That is what firms are typically like. Firms are usually more like a Harvey Norman retail store with row after row of fridges, rather than a house with just one or two fridges. Cost objects are simply different aspects of a firm about which managers want to have some understanding of their costs, and so they attach costs to them. As we said before, they can be any aspect of a business for which costs can be measured and assigned, and can include specific products, services, business processes, and activities. Costs can be allocated to basic units of work, such as operating a store, storing goods in a warehouse, sending bills to customers, or recruiting new staff. Indeed, every activity in a firm costs the firm something. The important thing to remember about this linking of costs to cost objects in a firm is that managers will usually go ahead and make decisions based on the way costs are allocated within a business. After all, that is the reason for allocating costs to cost objects in the first place. The way costs are allocated to cost objects will help shape and direct decisions by managers, such as decisions about how much of different products to sell, product mix decisions, their selling prices, whether to outsource manufacturing processes to Vietnam, or whether to close an underperforming store. Remember the words of the accountant troll to Dilbert, which we quoted in Chapter 1, Section 1.1. Some people think numbers merely reflect reality, but we believe that numbers create reality. How might numbers create reality rather than merely reflect it? By influencing and driving decisions made in a business. We've seen that managers need to control costs in a firm, since people in firms are spending other people's money. To do this effectively, managers need to have a clear sense of where within their firm costs are being incurred and why. Attaching costs to various cost objects can help them do this. It can also help managers plan and set the way forward for a firm. Past costs in a firm can be a starting point for managers to forecast future expected costs. You tend to want to know where you are now so you can plan where you want to be in the future. This is because to get where you want to go in the future, you must get there by going from where you are at present. Knowing your current cost structures well is a critical part of knowing how things are currently going in your business. For example, firms typically have inventories of products they have not yet sold, perhaps sitting in their warehouses or in their stores. If they manufacture products, they may have some raw materials and partly finished products sitting in their factories. We will see these all need to be valued at cost at each balance date. Managers need to have an understanding, especially at balance date, but also throughout the year, about the cost of these inventories. Products are as cost objects. We will focus on products as one type of cost object in a firm, as one type of fridge door onto which we can attach our fridge magnets. We'll do this because it is usually critical for firms to determine the cost of their products. One reason for this is that a firm needs to value its inventories of products regularly to be able to calculate its profit for a period. Why does it need to do this? Well, we know profit equals revenue less expenses. What usually happens for most businesses is that there is a lag between when a firm buys or manufactures its products, incurs expenses, and when it sells them, receives revenue. This means products will usually be stored by a firm as inventories for a period before they are sold. So at the end of a period, a firm will usually be holding some inventories of products in its warehouses or retail stores that are waiting to be sold. We saw in Chapter 2, Section 2.3, that accrual accounting requires the matching of expected costs and benefits of economic activities in a period to help us arrive at a firm's profit for a period. Where a firm has inventories at balance date, costs will have been incurred by a firm in buying or manufacturing these products. Yet these products will not have been sold and will not have generated any revenue. If we deduct the costs of buying or manufacturing products we intend to sell but do not include the revenue because they have not yet generated any revenue, we will understate our firm's profit for the period. This is because our expenses for the period will include the cost of the products we are still holding in our inventories, but we will not have included any revenue from selling them. If we then sell the products in the next period, we would receive the revenue generated by the products in that period, but would not include the costs in buying or manufacturing them. So again, we would not have matched the expected costs and benefits of economic activities in a period. This would overstate our firm's profit for this period. To avoid this problem, we put the costs of our products into an asset, inventories, and do not include them as an expense until we sell them, which we call cost of goods sold. In this way, we can match the revenue and expenses in a period for the products we sell in that period. For this reason, we need to value our inventories, which means we need to identify the cost of our products. This is one reason why products are a common cost object. There are other reasons why it is important for managers to have a good understanding of the costs of each of the products of their firm. It helps with setting prices, and it focuses the attention of managers on which products are more or less profitable, whether certain product lines should be discontinued or whether certain product lines should be emphasized within a firm's marketing and distribution activities because they provide the highest profit. We've looked at the idea in accounting of cost objects. We have seen they are any aspect of a firm to which we can attach costs in our business. In the next section, we will look at how we can use this idea of cost objects to determine the cost of a firm's products. 6.2. Cost of products. Indirect overhead costs are often included as product costs in inventory, rather than expensed as period costs. This can create a great short-term incentive to overproduce to inventory. This characteristically leads to month, quarter and year-end production spurts, production planning problems, excess inventory and stale, discontinued product pushed onto the customer. Justin Petit. In this section, we will look at how costs are attached to cost objects. Although any aspect of a business can be used as a cost object, we will focus on products as one key type of cost object. We will look at the difference between direct and indirect costs. We will see that allocating direct costs to products is usually straightforward. However, apportioning indirect costs is usually not so simple. Indeed, we often use the word allocate to describe attaching direct costs to products, indicating a straightforward process not involving judgments. And we often use the word apportion when attaching indirect costs to suggest the need to make some judgments and assumptions. We will look at some of the methods managers can use to apportion indirect costs to products. You may often hear the term overheads to refer to indirect costs. We will not use this term, as overheads can also be used to refer to period costs. We want to clearly distinguish between indirect costs and period costs, which are the overheads we do not apportion to products but treat as expenses each period. And we will see it is vital to understand the assumptions used to apportion indirect costs to products in a firm, if we are to use accounting information on product costs to help us better understand what is really going on in a firm. Direct and indirect costs. Some costs can be easy to allocate to cost objects. For example, the salaries of nursing staff working in Ryman Healthcare's rest home in its Malvina Major retirement village in Johnsonville, Wellington. These salary costs are a direct cost of operating that rest home. Here, the cost salaries of nursing staff is clearly linked to or driven by the cost object, business process of operating the rest home. These costs, like a magnet, can be clearly seen to stick to the cost object. These are direct costs. However, in other cases, the links are not so clear-cut. Because the connections between these costs and the cost objects are not so obvious, some judgments and assumptions need to be made to connect these costs to the cost objects. It is less like a magnet naturally sticking to a fridge door, and more like sticking something to a fridge door with blue tack. These are indirect costs. It is important to realise that the apportionment of indirect costs to a cost object involves apportioning costs that are not directly linked or caused by a cost object, or at least we cannot easily measure those linkages. The process of attaching direct and indirect costs to cost objects is set out in Figure 6.1 below. Figure 6.1, attaching costs to cost objects. Firms that make things. Although there are quite a few manufacturing businesses in Australia and in other countries, most businesses in many developed countries are in the service industries, such as banking and finance, retail, healthcare, transport, tourism, education and technology. People are serving in cafes or restaurants, selling cars, driving trains, dealing in the money market, designing houses, teaching school children, nursing patients in hospitals, checking people's teeth, filming movies, providing gardening services, and caring for animals in the city zoo. Indeed, our economies are gradually transforming themselves into knowledge economies, where the knowledge embedded in and developed by people is becoming more and more critical to the creation of value by firms. With the strong emphasis on service and knowledge industries in our economies, people and what they do are becoming increasingly central to success in business. Service industries involve people working in offices, talking on Zoom, photocopying, moving pieces of paper around, working on computers, and sending emails. They also involve people fixing broken pipes or painting houses or driving buses. They include flight attendants serving drinks on a plane and paramedics administering first aid and taking us quickly to hospital. The difference between products and services can also become blurred, as products and services are often supplied together, such as a meal in a restaurant, a product, accompanied by a waiter serving us a service, or our house is painted through the supply of paint, a product, and people who paint it onto our house, a service. In Australia and in many other countries, we are living primarily in service and increasingly knowledge economies. However, we still have some manufacturing businesses. One thing about manufacturing businesses is that the products are easy to see and understand. They are physical products that go through a clearly visible and physical manufacturing process that directly combines various materials and labour, direct costs, in a context of a factory and broader organisation that incurs a range of other costs, indirect costs. To help us think about, understand, and personally engage with the issues involved in attaching costs to products or services, we will focus on physical products that are manufactured in a firm. However, these issues and ideas are directly relevant to firms in service and knowledge industries. Job and process costing. Just as we can easily throw a fridge magnet onto our fridge door, so the allocation of direct costs to a cost object is usually easy to do. The most common direct costs are direct material and direct labour costs. When the products being manufactured are readily able to be separately identified during the manufacturing process, direct and indirect costs can be attached to individual products or small groups of products during the production process. For example, a Tesla Model Y being progressively constructed on a production line at the Tesla Fremont factory in California, or a new building being constructed for Ryman Healthcare's Nellie Melba retirement village in Melbourne, are readily able to be identified while they are being made. We see each of them as something separate from other cars on the production line or other buildings being constructed. Since it is separately identifiable while it is being built, we have something we can attach costs to while it is being constructed. In such cases, a job costing approach can be used to allocate costs to these products. However, sometimes products are not able to be separately identified until the manufacturing process is largely complete. Such a process is making chocolates at the Cadbury chocolate factory in Claremont in Tasmania. In this case, we cannot see the specific chocolate bars until the manufacturing process is largely complete. Only at this late stage do you have separately identifiable products. So we cannot attach the direct and indirect costs incurred in making chocolates during the manufacturing process to products or groups of products. So what do? In these cases, we can instead calculate an average production cost across all the products being produced at each stage in the production process. Let us think about how Cadbury makes chocolate in its factory in Claremont in Tasmania. To make 100,000 250 gram blocks of Cadbury Dairy Milk chocolate, we need 58,000 litres of fresh full cream milk, 3.75 tonnes of cocoa butter, 2.75 tonnes of cocoa mass, and 11.5 tonnes of sugar. These are the direct materials. These materials are mixed together in a large heated vat until they form into a type of paste. This mixing process takes a few hours to blend all the materials together and to reduce the amount of water in the mixture. After mixing is completed, the paste is then refined in a grinder to reduce the size of each of the particles of cocoa and sugar that are in the paste. This makes the chocolate feel smooth in the mouth rather than gritty. Indeed, the particles are reduced to as small as 25 microns, which is so fine we would need a powerful microscope to see the individual cocoa and sugar particles. The next stage of production is conching, where the smooth paste is heated and mixed in a backwards and forwards motion for about 8 hours to develop the flavour and texture of the chocolate. The final stage in the production of the chocolate is tempering, which takes the chocolate through a complicated process of heating and cooling that distributes the fat particles evenly throughout the chocolate. This means all the chocolate will have the same melting point and be less likely to melt on touch. At this point, we now have a batch of chocolate which is stored in heated vats and stirred continually. The final stage in producing the blocks of chocolate is moulding. Rows of chocolate block moulds travel along a conveyor belt and a measured amount of chocolate is deposited into each one from a large hopper above the moulding line. The moulds are vibrated on the belt to make sure the chocolate inside is level and that there are no air bubbles. The moulds pass through a long cooling tunnel where the chocolate sets. Once the chocolate is solid, the moulds are tipped upside down and the blocks are knocked out onto a conveyor belt. After final quality inspection, the blocks are machine sealed in foil, wrapped and packed, ready for distribution. We can see Cadbury has several processes which could be organised in separate departments that are involved in the manufacture or production of chocolate. These are the mixing, refining, conching, tempering, moulding and packaging processes. Direct material and direct labour costs involved in each production process would be relatively straightforward to allocate to each production process. We can then divide the costs allocated to each of the production processes or departments by the volume or number of units of chocolate products, say kilograms, to obtain an average unit cost per kilogram of chocolate. This is called process costing, because we allocate costs to products by first allocating them to a manufacturing process, rather than to a specific product or group of products. Collecting and allocating direct costs to cost objects, whether we use job costing or process costing, is relatively straightforward. The difficulties arise with apportioning indirect costs. For example, apportioning indirect costs such as electricity, council rates and building maintenance costs of the Cadbury factory at Claremont are less straightforward to connect to cost objects. Before we look at these difficulties, we will first look at how some costs can be seen as product costs and others as period costs. Product and period costs. Product costs are all those costs that have been allocated to products like fridge magnets, with or without the help of blue tack, on the various fridge doors of each of our firm's products. All other costs of a business not clinging onto our products are usually classified as period costs. These costs are included as an expense in our firm's accounts in the period in which they are incurred. This implies we think these costs have reasonably been incurred in the generation of revenue of that period, as revenue less expenses for the period will equal profit for the period. On the other hand, product costs, that is, those costs attached to our products, only become an expense in our firm's accounts when the product to which they are attached is sold. Prior to the product being sold, all the product costs attaching to it in the firm's accounts are an asset of the firm, or in other words, are a present economic resource controlled by a firm that has the potential to produce economic benefits through future sale of the product. These assets are usually called something like work in progress or finished goods inventories. By contrast, period costs are expenses when they are incurred and are not seen to have the potential to produce economic benefits for our firm in the future. A lot of the difficulties of understanding costs in a firm are caused by the need to measure profitability and economic performance during a period. Managers need to clearly understand how costs are being handled in their firm's accounts if they are going to be able to use their firm's management accounts to help them better engage with the realities of their firm. Equally, external users of a firm's accounts will need to have a clear understanding of the allocation of costs, particularly between product and period costs, if they are going to be able to understand the valuation of inventory and determination of profit in a firm's external financial statements. If we want to look at our firm's performance over periods shorter than its total life, we're going to need to attach costs to our products. Allocating direct costs to our products is relatively simple. The difficulties usually revolve around apportioning indirect costs to products because the links of indirect costs to products are, well, indirect and require us to make some judgments in attaching them to our products. We will now have a look at the two main approaches used to apportion indirect costs to products, which are the functional-based and activity-based systems.